Chapter 6. Financial IQ Number 4. Leveraging Your Money. On August 9, 2007, the stock market plunged nearly 400 points. The Federal Reserve and central banks around the world began injecting billions in cash into the economy to make sure the panic did not spread. The market was still nervous the next day. As I was getting ready for the day, a newscaster on a morning television program was interviewing 3 financial planners and getting their opinions. Their unanimous advice was, don't panic. Stay the course. When asked for further advice, all 3 said, save money, get out of debt, and invest for the long term in a well-diversified portfolio of mutual funds. As I finished shaving, I wondered if these financial experts had all gone to the same school for parrots. Finally, one advisor took a moment to say something different. She began by condemning the real estate market for causing the mess in the stock market, blaming greedy investors, unscrupulous real estate agents, and predatory mortgage lenders for causing the subprime mortgage mess, which led to the crash in the stock market. This advisor said, I told my clients that real estate was risky, and my advice has not changed. Real estate is a risky investment, and investors should invest for the long term in blue chip stocks and mutual funds. As the financial planner on television was ending her attack on real estate, my wife Kim walked into the room and said, remember we have a closing today on the 300-unit apartment house. Nodding my head, I said, I'll be there. As I finished dressing, I thought, it's funny, the financial advisor saying that investing in real estate is risky. The real estate markets are crashing at the same time Kim and I are buying a $17 million apartment house in Tulsa, Oklahoma. And we are excited about it. Are we on the same planet? The new capitalism. On August 9 and 10, 2007, as investors lost billions of dollars, the U.S. Federal Reserve Bank was injecting billions of dollars into the banking system, doing its best to stop the panic in the real estate, stock, and bond markets. This injection of capital is an example of how the new capitalism operates, an economic system built on debt and manipulation by central bankers playing games with the world's money supply. It's almost like you and I using a credit card to pay our credit card bills. Later that week, I was asked to be a guest on 2 television and 3 radio programs to comment on the crash. The hosts wanted to know what I thought about it, as well as what I thought about the Federal Reserve injecting cash into a crashing market, and whether the Federal Reserve Bank should save the market by lowering interest rates. In all of my interviews I said, I don't like the central banks manipulating the markets. I don't feel the government should bail out the rich hedge funds and financial institutions, shielding them from their own greedy mistakes. I also said, I do feel for the little guy. In one day, millions of hardworking people who do not play games with money, watched their homes decline in value in the real estate market, their savings decline in value in the bond market, and their retirement portfolio decline in value in the stock market. When asked if I was continuing to invest, I said, yes. When asked if I thought it was risky to be investing in crashing markets, I replied, there is always risk. I then completed my thoughts by saying, the ups and downs of markets do not affect why I invest or what I invest in. 2 points of view. Although the question was not asked, I thought a better question might be, what is the difference between the financial planner who was negative on real estate and my point of view about investing in real estate? Or, why, while so many people were panicking, was I excited about buying more property? The answers to those questions are provided in this chapter through 2 financial concepts, control and leverage. As stated repeatedly in this book, the rules of money changed after 1971 and 1974. There are new rules, and a new capitalism. In 1974, millions of workers began losing their paycheck for life, known as a defined benefit pension. They now had to save and invest for their retirement in defined contribution pension plans. The problem is most people have very little financial training or education in order to invest for their retirement properly. Another problem is the new rules of capitalism require workers to invest in assets they have no control and no leverage over. During market crashes, all most can do is watch helplessly as the financial hurricane whipsaws their wealth and financial security. The new capitalism puts millions of workers' money into investments that allow them very little control or leverage. Because I have control over my investments, in this example a 300-unit apartment house, I am not as affected by market crashes. Because I have control, I am confident about using a lot more leverage. Due to control and leverage, I can achieve greater wealth, in less time, with very little risk, and and minimize the effect of the booms and busts of markets on my investments. The market has been crashing for a long time. As I wrote earlier, USA Today did a survey and found that the greatest fear in America was not terrorism, but the fear of running out of money during retirement. After August 9 and 10, 2007, I am sure that fear spread a little further. The people who are worried have good reason to worry. When you look at the two charts below, you can see the effect of the rule changes of 1971 and 1974 on the value of the stock market. As you can see, the market has actually been crashing for a long time. Just like housing, as the Dow is going up in price, its purchasing power is actually coming down. This loss of monetary purchasing power makes the financial future of most workers less secure. These charts say their future will cost them more money and become more expensive. Without leverage, most workers cannot put enough money aside for their future, because the more money they save, the less valuable it becomes. There is a funny story about the German economy just before Hitler came to power that illustrates this concept. The story goes that a woman took a wheelbarrow filled with money to the bakery to buy a loaf of bread. After negotiating a price for the bread, she came out of the bakery to get her money, only to find that someone had stolen her wheelbarrow and left her money. This is happening to the American saver. How much will a retired person need in savings to afford retirement in such an inflationary economy? What happens if you are retired and need life-saving surgery, which government medical programs will not pay for? What do you do if your problem is not having enough money to retire on? This is why financial IQ number 4, leveraging your money, is so important. Leverage makes your money work harder for you by using other people's money, and if you have a high financial IQ number 3, you can pay less and less in taxes. What is leverage? In very simple terms, the definition of leverage is doing more with less. A person who puts money in the bank, for example, has no leverage. It's the person's money. $1 in savings has a leverage factor of 1. The saver puts up all the money. For my investment in the 300-unit apartment house, my banker put up 80% of the $17 million real estate investment. By using my banker's money, my leverage is 1. For every dollar I invest in the deal, the bank lends me $4. So why did the financial planner on TV say that real estate was such a risky investment? Once again, the answer is control. If an investor lacks the financial intelligence to control the investment, the use of leverage is very risky. Since most financial planners put people into investments where they have no control, they should not use leverage. Using leverage to invest in something you do not control would be like buying a car without a steering wheel and then stomping on the gas pedal. Most of the people being hurt by the real estate meltdown are people who were counting on the real estate market to keep going up and increasing their home's value. Many people borrowed money against their inflated home value. Now their home may be worth less than what they owe. They have no control over the investment and are at the mercy of the market. Many homeowners who still can make their mortgage payments feel bad because the value of their home has dropped. They watch the equity in their home disappear. When housing prices drop, many homeowners feel they have lost money. This is sometimes referred to as the wealth effect. Due to inflation, which is not really an increase in asset value but a decline in purchasing power of the dollar, many people feel wealthier as their home's value appears to increase. When they feel wealthier, they borrow more money, leverage, and spend more money on liabilities. This is a direct result of the new capitalism, an economic expansion based upon the decline of the dollar and an increase in debt. My worth is not based upon net worth. The wealth effect is rooted in the illusion of net worth. Net worth is the value of your possessions minus your debt. When a house goes up in value, most people feel their net worth has gone up. For those of you who have read my other books, you may already know that I feel net worth is worthless, for 3 reasons. 1. Net worth is often an estimate based upon opinions, not facts. The value of a home is only an estimate. You will not know the true price until the house is sold. This means many people overinflate their home's estimated value. Only until they sell their home will they know the facts, the real price and the real value. Unfortunately, many people may have already borrowed against the perceived value of their house and may owe more than they can sell the house for. 2. Net worth is often based upon possessions that have a declining value. When I fill out a credit application, I'm allowed to list most of my possessions in the asset column. I'm allowed to list my business suits, shirts, ties, and shoes as assets, just as I can list my cars. You and I know that a used shirt has very little value, and a used car has considerably less value than a new car. 3. Net worth going up is often caused by the dollar going down. Some of the appreciated value of a house is due to the decline in value of the dollar. In other words, the house is not going up in value. It just takes more dollars to buy the same house because the government and central banks keep injecting more funny money into the system to keep the economy afloat, and to keep the feel-good illusion of prosperity alive. A politician's greatest fear. The reason I use the words, feel-good illusion of prosperity, is because the greatest fear of politicians and bureaucrats is people feeling bad. Throughout history, kings, queens, and rulers have been overthrown and even executed when the people feel bad. You may recall the French people chopped off the head of their queen, Marie Antoinette, and the Russian people executed the last Tsar, his wife, and his kids. The old capitalism was based upon tough economic fundamentals. This new capitalism is based upon feel-good economics. As long as a person's net worth is going up, the illusion of prosperity, based upon debt, not production, continues. Who needs freedom when you've got things? As long as the world economy allows the US government and the US consumer to borrow and spend, the fairy tale global economy will continue. If the dream turns into a nightmare and the feel-good bubble bursts, heads will roll again. They may not roll physically, but heads will roll politically, professionally, and financially. Value not based upon inflation. The value of my $17 million apartment house is not based upon inflation or the price of the building. While price is important, I am not counting on the price of the building going up due to some magical, unseen market condition. I am not counting on an increase in net worth to feel good, or worrying about a market crash and feeling bad. That is why the booms and busts of the markets do not concern me that much. The value of my apartment house is based upon the rent my tenants pay. In other words, the true value of the property is the value my tenants think the property is worth. If a renter thinks the apartment is a good value at $500 a month, that is the property's value. If I can increase the perceived value of my property to my tenants, I, not the market, have increased the value of the property. If I increase rents without an increase in perceived value, the tenant moves to the community down the street. The value of rental real estate, in this case my apartment houses, is dependent on jobs, salaries, demographics, local industry, and supply and demand of affordable housing. In a housing crash, the demand for rental units often goes up, which means demand and rents go up. If rents go up, the value of my rental real estate may go up, even if the value of residential real estate is coming down. There are 3 specific reasons why I'm not concerned about market crashes when it comes to the purchase of my 300-unit apartment house. One reason is because Tulsa, Oklahoma, is an oil boomtown. High-paying jobs are plentiful. The oil industry needs workers, and transient workers need rental housing. The second reason is because a local college near the apartment house is doubling its number of students, but not the number of on-campus housing units, which increases demand for rental apartments. As many of you know, there is another baby boom commonly referred to as the Echo Boomers, a generation just now entering college, which is 73 million strong. A majority of them will be renters. The third reason is because the fixed interest rate on the existing loan is very low. Low interest payments, lower expenses, and increasing income will increase property value, not market fluctuations. This means the 300-unit apartment house offers me both control and leverage. My job as an investor on this apartment house is to increase my leverage from 1.4 to possibly 1.10, i.e., doubling the value of the property through operations, not the market. I can do this as long as I have control. Leverage is not risky. Many financial advisors will tell you that higher returns mean higher risk. In other words, leverage is risky. That is absolutely false. Leverage is risky only when people invest in assets that they have no control over. If a person has control, leverage can be applied with very little risk. The reason most financial advisors say that higher returns mean higher risk is simply because they sell only investments that allow very little control. As mentioned above, my $17 million apartment house in Tulsa is a good investment to use leverage with because I have control over the operations, and the operations, i.e., the amount of income that is collected through rents, determine the value of the investment. A house is not a good investment, and leverage is risky with a house because you do not control the value of the house. The value of a house is based on the market and the purchasing power of the currency it was purchased with. These things are out of your control. What is control? The major flaw in paper assets such as savings, stocks, bonds, mutual funds, and index funds is the lack of control. And because you have no control, it is difficult and risky to apply leverage. Because these paper assets offer very little control, it is difficult to get a bank to lend you any money to invest in these assets. So, what is control? The diagram of the financial statement illustrates 4 of the main controls a professional investor and a banker want. As an entrepreneur, I have control over the 4 columns in the financial statement of my business. As a real estate investor, I also have control over the 4 columns of the financial statement of my investment. Financial intelligence is the key to control. Financial intelligence is the key to control. Financial intelligence increases control, and financial IQ measures the financial returns of financial intelligence. Take the 300-unit Tulsa apartment house as an example. 1. The income column. The first step after acquiring the property is to increase the rent. The property is already profitable and cash flows with existing rents. In other words, I am already making money from day one. Even so, the objective or business plan is to raise the rent per unit an additional $100 a month over the next 3 years by the following means. 1. Raising the existing rents that are under market. 2. Installing washers and dryers in all the units and charging extra for rent. 3. Completing improvements to the property like landscaping and new paint. All of these can be completed by using the bank's money, not mine. When we provided the bank our business plan, these improvements were part of it, and were factored into the total loan amount. Multiplying 300 units by $100 over 3 years, this increases the entire project's monthly income by $30,000 a month, or an additional $360,000 a year. This increase in income is an example of control and leverage. If the plan works, 3 years from now my financial IQ number 4, leverage, will be infinite because the increase in income will be achieved by no additional capital from investors, just good knowledge of how to manage the asset control, to higher and higher profitability. The increase in financial IQ is infinite because the increase in income will be achieved using investor control and the bank's money. 2. The expense column. The next controllable objective is to lower expenses. This is done in different ways. One specific example is by reducing labor costs through reduced administrative costs. Since we own other properties, many costs can be brought back to the main company. These are sometimes called back office expenses. They are the cost of accountants, bookkeepers, attorneys, and administrative staff. Other expenses that can come down are insurance, property taxes, water consumption, maintenance, and landscaping through better cost management and economy of scale. Also, expenses can be reduced and income can go up by keeping turnover low, the time it takes to re-rent an apartment. For example, the moment a tenant informs the management company that he or she is leaving, an ad is run advertising the apartment's availability. Once vacated, the cleaning crew comes in that day, and the apartment is ready to show to a potential new tenant that night. And in many cases, an apartment is rented before the existing tenant even moves out. Obviously, many incompetent investors fail to reduce expenses and actually increase them, making the property a bad investment for them. Often, they fail to manage the quality of tenants and the attractiveness of the property because they are trying to save money. In most cases, the property goes down in value. It's these poorly run properties that we like to buy because we can turn them into good investments through good property management. In other words, we make good money from bad investors. Property management is a key control. As you know, property management is one of the keys to profitability of real estate. Property management is a key control. Like most investors, I hate property management. That is why I have Ken McElroy, author of the ABCs of Real Estate Investing, as a partner. His company is absolutely the best. If you would like more information on property management or how to increase the value of real estate through property management, the Rich Dad Company offers several books and audio products created by my friend and investment partner Ken, whose company is a leading property management company in the southwestern United States. One of the reasons why I stay clear of most stocks and mutual funds is because I have no control over expenses, especially management salaries, bonuses, and fees. It makes me sick to read about a greedy CEO's increase in pay, even as shareholder value drops. For example, Robert Nardelli, CEO of Home Depot, was being paid $38 million a year in salary, plus a guaranteed $3 million bonus each year. Unfortunately, Things didn't go well and Nardelli finally resigned, but only after the board of directors agreed to pay him $210 million to do it. To me, this is excessively expensive, and a rip-off. It's why I don't like paper assets. Most paper assets are run by MBAs, employees who think more about their personal finances than their investors' financial security. By the way, Home Depot's executive compensation, while high, is not necessarily an exception. It's the norm. 3. The liability column. My 300-unit apartment house had an existing mortgage interest rate of just 4.95%. The low interest rate increases the asset value of the entire property. By adding a second mortgage at 6.5%, we created a blended rate of about 5.5%, taking into account the different amounts of the two loans. This low interest rate is an important control and leverage. A percentage point on millions of dollars has a great impact on net income. For example, a 1% savings on a $10 million mortgage is $100,000 in extra income annually. As the diagram below illustrates, reducing debt and interest rate expense on debt is also an example of leverage. 4. The asset column. By increasing rents, reducing expenses, and reducing debt, or interest on debt, the asset value of the property increases. As you can see by the financial statement diagram below, having controls and getting numbers to move in the desired direction are a form of leverage, and a function of financial intelligence. Bobbing for apples. Today, with the ups and downs of the market, many investors look like old-time carnivalgoers who bobbed for apples floating in a tub of water. It looks like fun, but it's not something I want to do every day just to make a buck. Rather than watching the price of my stock or mutual funds bob up and down in the market, I want control over my financial statement. By having the financial intelligence to control income, expenses, debt, and ultimately the value of my investment, I have control over my financial destiny. The investor has no control and no leverage power in any of the four columns of the financial statement with savings, stocks, bonds, mutual funds, or index funds. A pause before going on. Before going on into higher forms of leverage and control, I believe it is important to recap and review the points covered so far, before getting more complex. These are the 7 points. Point number 1. There are many types of leverage. The financial leverage most people are familiar with is the leverage of debt, aka OPM, other people's money. There are other types of financial leverage, such as the leverage of financial intelligence applied to financial controls. In fact, all 5 financial intelligences, which are increasing income, protection from predators, budgeting, leverage, and information, are forms of leverage. Leverage is anything that makes your job a little easier. It's easier to move a heavy object with a forklift, and it's easier to make a sophisticated investment decision with a higher financial IQ. Point number 2. Most investors invest in paper assets, assets they have very little control over. Examples of paper assets are savings, stocks, bonds, and mutual and index funds. Because these assets allow little to no control, these investors have very little leverage and low returns on investment, and reflect a low financial IQ. An example of low financial IQ is a 5% return on savings, paying taxes on that return, and then having inflation almost wipe out its value. Point number 3. An increase in returns does not mean an increase in risk. When financial advisors say that an increase in returns means an increase in risk, they are right when speaking about paper assets. They are wrong when speaking for all assets. Assets such as a business or real estate require more financial intelligence, allow for more financial control, and permit a higher degree of leverage with very low risk. The key to low risk is higher financial intelligence. This is why I recommend that people start small and stay small, as they allow their financial intelligence to increase. With an increase in financial intelligence, their returns on their investments increase. If financial intelligence is low, then leverage may deliver a blow to financial IQ, the measured returns on the investments. Point number 4. Most financial advisors are not investors. Financial advisors are simply salespeople. Most financial advisors, even many real estate brokers, invest only in paper assets, if they invest at all. Most have very little leverage professionally and financially. In many cases, their professional and financial leverage ratios are 1:1. A1. 1 professional ratio means they get paid for their work, and only their work, a day's pay for a day's work. As a business owner, I have thousands of people working to assist me. As an investor, Like in the example of the Tulsa apartment house, I have 300 tenants helping me pay for my investment, the bank lending me $4 for every one of my dollars, and the tax department giving me tax breaks on my income. These are examples of different types of leverage. Point number 5. Financial education increases financial intelligence. Most people invest in paper assets such as savings, stocks, bonds, and mutual and index funds because they do not need or want control. All they want is to turn their money over to an investment advisor who hopefully does a good job. Out of sight, out of mind. If people want more control, the first thing they need to control is their financial education, which increases their financial intelligence and hopefully increases their financial controls and leverage ratios. Point number 6. Leverage can work in two ways. Leverage can make you rich and leverage can make you poor. This is why leverage requires financial intelligence and financial controls. With stocks, a trader can use the leverage of options. If a trader thinks the market is going up, the trader may use a call option, which is the right to purchase a stock at a certain price within a certain time. For example, if the stock is $10 today and the trader senses the price will go higher, the trader may buy a call option for $1. If the trader is correct, and the stock goes to $20, the trader has made $10 with $1. If the trader thinks the market is going down, the trader may use a put option, or short the stock. In other words, a trader has the potential to make money if the stock price is going up or going down. The problem, however, is that the trader has no control over the asset, just control over the terms of their trade. As expected, most financial advisors who sell mutual funds and recommend diversification say that trading a stock is risky, and it is for those who lack training and experience. Learning to trade a market, even in real estate, is an important part of an investor's financial education. Real estate investors also use options. In real estate, a call option is known as a down payment. If you are a flipper, a down market in real estate can be disastrous. Since most of my investment in real estate is based upon rental prices and operating costs of a property, up and down markets in real estate do not affect me as much. While I do occasionally flip a property, especially if someone is willing to pay me a ridiculous price for it, as a practice I would rather buy a property and collect rent and other income for a long time. Then I look for another property to buy and hold. For those who are interested in learning about investing in up and down markets, we have our board game Cashflow 202, a game that teaches you to trade with play money. Cashflow 202 is an addition to Cashflow 101. It is strongly recommended you start with Cashflow 101 before moving on to Cashflow 202. There are Cashflow clubs all over the world for people who want to learn the games before purchasing them. Financial education is essential for anyone wanting to use more leverage. Point number 7. When most financial advisors recommend diversification, they are not really diversifying. There are two reasons why the diversification they recommend is not diversification. The first reason is that financial advisors invest in only one category of asset, paper assets. As the market crash of August 9 and 10, 2007, revealed, diversification did not protect paper asset values. The second reason is that a mutual fund is already a diversified investment. It is a hodgepodge of good and bad stocks. When a person buys several mutual funds, it is like taking several multivitamins. When a person takes multiple multivitamins, the only thing that goes up in value is the person's urine. Professional investors don't diversify. As Warren Buffett says, diversification is a protection against ignorance. Diversification is not required if a person knows what they are doing. My rich dad would say, whose ignorance are you protecting yourself against? Your ignorance, your advisor's ignorance, or your combined ignorance? Instead of diversify, professional investors do two things. One is to focus only on great investments. This saves money and increases returns. The second is to hedge. Hedging is another term for insurance. For example, my 300-unit apartment house is required by the bank to have all sorts of insurance. If the property burns down, insurance pays my mortgage and rebuilds the building. Best of all, the cost of the insurance is paid out of the rental income itself. Two of the main reasons I do not like mutual funds is that banks do not lend money on them and insurance companies will not sell me insurance against catastrophic loss if the market crashes, and all markets crash. On to more leverage, higher returns, and lower risk. Focus, not diversification, is the key to more sophisticated leverage, higher returns, and lower risk. Focus requires more financial intelligence. Financial intelligence begins with knowing what you are investing for. In the world of money, there are two things investors invest for: capital gains and cash flow. 1. Capital gains. Another reason so many people think investing is risky is because they invest for capital gains. In most cases, investing for capital gains is gambling, or speculation. When a person says, "I'm buying this stock, mutual fund, or piece of real estate," he or she is investing for capital gains, an increase in the price of the asset. For example, if I had purchased the $17 million apartment house hoping I could sell it for $25 million, then I would be investing for capital gains. As many of you know, investing for capital gains means a tax increase in some countries. 2. Cash flow. Investing for cash flow is a lot less risky. Investing for cash flow is investing for income. If I put savings in the bank and receive 5% in interest, I am investing for cash flow. While interest is low risk, the problem with savings is the return is low, taxes can be high, and the dollar keeps losing value. When I purchased the 300-unit apartment house, I was investing for cash flow. The difference is I was investing for cash flow using my banker's money for a higher return on investment and paying less in taxes. That is a better use of leverage. What are you investing for? Most financial advisors recommend that a person invest in growth funds when he or she is young. Investing for growth is investing for capital gains. They advise older investors to then shift their growth funds into income funds or annuities. In other words, invest for cash flow when you are older. They believe cash flow is less risky and more certain. 3 types of investors. When it comes to capital gains or cash flow, there are 3 general types of investors. They are: 1. Those who invest only for capital gains. In the world of stocks, these people are called traders, and in the real estate market they are called flippers. Their investment objectives are generally to buy low and sell high. When you look at the cash flow quadrant, traders and flippers are actually in the S quadrant, not the I quadrant. They are considered professional traders, not investors. On top of that, in America, traders and flippers are taxed at the higher S quadrant tax rates and do not enjoy the benefits of the tax breaks the I quadrant receives. 2. Those who invest only for cash flow. Many investors like savings or bonds because of the steady income. Some investors love municipal bonds because they pay a tax-free return. For example, if an investor buys a tax-free municipal bond paying 7% interest, the effective return on investment ROI is the same as receiving a 9% taxable return. In real estate, many investors love triple net leases (NNN). With NNNs, investors receive income without the expenses of taxes, repairs, and insurance. The tenant covers those costs. In many ways, a triple net lease is like a municipal bond, because a lot of the income can be tax-free or tax-deferred. While I love triple net properties, as expected, the trouble is finding a good property with a good tenant willing to pay a high return. Today, as I write, most NNN properties are only paying about a 5% to 6% return. Not that exciting. The good news is that if I dig deeper, which I will go into later, I might be able to find a property with a much higher return, all the while using more leverage in my bank's money to lower my risk, which is why I prefer triple net real estate over tax-free municipal bonds. This leads us to the 3rd type of investor. 3. The investor who invests for capital gains as well as cash flow. Years ago, old-time stock investors invested for both capital gains and cash flow. Old-timers still talk about the price of a stock going up as well as paying the investor a dividend. But that was in the old economy, the old capitalism. In the new capitalism, most paper investors are looking for the quick buck, to make a killing. Today, the big investment houses are hiring the smartest whiz kids out of college and using the power of supercomputers and computer models to look for the slightest market patterns they can exploit. For example, if the computer picks up a 1% differential, let's say in tech stocks, the investment house will bet millions of dollars, hoping to gain 1% on millions of dollars in a few hours. This is very high leverage, and very risky. These computer models also cause a lot of the volatility in the markets and often cause crashes. When the stock market announces that program trading has been halted, it is talking about these computer programs being halted. The markets crash if the computers say sell. If the computers say buy, the markets boom, and then they crash. In other words, prices can go up or down for no fundamental or business reason at all. A stock price may have no relationship to the value of the company because the computers created an artificial supply or demand. If you recall the dot-com era, companies that were not companies, but rather just good ideas, were valued at billions of dollars, and companies that were really valuable had their share prices trashed when the dot-com boom busted. As an old-time investor in this new era of capitalism, I must be smart enough to invest for capital gains, cash flow, leverage of debt, and tax advantages, as well as be above the turmoil the whiz kids and supercomputers cause in the marketplace. For instance, I recently purchased a stock, even though I do not have control, because the company, an old boring industrial age company, historically pays a steady 11% dividend. When the share price dropped in the recent market crash, I bought the stock because the price of the cash flow became cheaper. So I do occasionally buy paper assets, but I tend to buy for cash flow. Being a little guy and not having control over the company, I do not use leverage. I only invest with cash I can afford to lose if I'm wrong. If this particular stock goes up in price, I may sell because I like investing for both cash flow and capital gains. My ROI, return on investment, goes up if and when I can receive both cash flow and capital gains. There are 3 components to being a good real estate investor. They are 1. Good partners. As Donald Trump says, you cannot do a good deal with bad partners. This does not mean bad partners are bad people. They may just be bad or wrong partners for you. For this 300-unit apartment house project to work, I must be sure I have good partners. My partners are my wife, Kim, Ken, and Ross. We have done many deals together and have made a lot of money. We have also run into many problems, and in solving the problems have become smarter and better partners. 2. Good financing. Real estate is primarily a function of financing. Many people say, location, location, location. I say, financing, financing, financing. If you can secure good financing, the deal works. If you have bad financing, the deal will not. To illustrate my point, let's say the seller says, I want $35 million for my $17 million apartment complex. If the seller lets me finance the $35 million purchase price at $1 a month for 30 years with a balloon payment of $35 million at the end of the term, I would take the deal and give the seller the asking price. At $1 a month for 30 years, I can afford to pay $35 million for a $17 million property. As they say in the world of finance, I'll give you your price if you will give me my terms. I know some of you think $35 million is just an extremely ridiculous example. It actually is not. In the world of finance, paying ridiculous prices is pretty common. It is often just a matter of who the buyer and seller are and their ability to use the power of finance to achieve their goals. For example, a few years ago, a piece of property came up for sale near my office. When I asked the broker what the price was, he said $2 million. I laughed, said he was joking, and left. At best, I thought the property was worth $750,000. Today, a major hotel chain is putting a flagship property on that piece of dirt. I do not know what that piece of dirt is worth today, but it is definitely more than $2 million. As my friend Ken McElroy says, the person with the better plan wins. And as Donald Trump says, think big. Every time I drive past that property, I say to myself, think bigger. 3. Good management. One of the reasons for my confidence in the $17 million, 300-unit property is that I have good partners. Ken owns a property management company, and his partner Ross owns a real estate development company. In the following paragraphs, I will further explain how property management and development are essential to increasing rents, lowering expenses, and increasing asset value. If I had bad partners, bad financing, and bad management, the 300-unit apartment deal would be a financial disaster. If I were the only one investing, I would not invest. It is too big and complex a project. Having control over these 3 components, good partners, good financing, and good management, I am more willing to use debt as leverage. Without control, I would probably not use debt financing. If there is higher risk, such as speculating in a stock or a commodity, I like to use only money I can afford to lose. Higher returns with less risk. I'm going to further explain my confidence in the investment thanks to my partners and having control over the 300-unit apartment project, why I am willing to use a lot of leverage, why I believe the risk is low, how I make more money, and how I pay less in taxes. There are three more advanced investment strategies that require a higher level of financial intelligence. The three advanced leverage strategies are OPM, ROI, and IRR. 1. OPM. Other people's money. There are many ways to use OPM. With the 300-unit apartment building, I am using 80% leverage. First of all, the beauty of using the bank's money is that it is tax-free money. The other benefits of the bank's money are: me. Bank. 1. Appreciation. 100%. 0%. 2. Income. 100%. 0%. 3. Tax benefits. 100%. 0%. 4. Amortization. 100%. 0%. As you can see from these numbers, the bank puts up 80% of the money but I receive 100% of the benefits. What a great partner. 2. ROI, return on investment. A confusing concept for many investors is the return on their money, or ROI. For example, when you read financial publications, many mutual funds claim they have gone up by 10%. But my question is, did any of that 10% return to the investor? And how did they measure the 10%? Some funds measure the 10% by the price of the shares in the fund going up. For example, if a year ago the price per share in the fund was $10 and today it's $11, they can claim a 10% return. In this case, the return was measured in capital gains. As an investor who invests for both capital gains and cash flow, the only return I count is the cash flow. For example, if I invest $10 and each year after taxes I put $1 in my pocket from cash flow, my return is 10%. I do not count the return on asset appreciation because it is an estimate and does not become a reality unless I sell the asset. The difference is that one measure of the ROI is in the price of the stock, and the other measure of ROI is money in my pocket. I actually want both, 10% in asset appreciation and 10% cash in my pocket. But cash flow is the only return that can be tangibly measured while I hold the asset. Matching 401k contributions with one's own money. Another confusing point is that financial planners claim companies match your retirement fund contributions. If the match is dollar for dollar up to a certain percentage, the advisor may claim that this is 100% ROI. That is not how I see it. My way of looking at matching contributions is that the company is simply putting my money in with more of my money. In other words, the contribution the company withholds and then contributes is still my money. It is money the company should have paid me anyway. It is part of my total compensation, an expense to the company. When I talk about leveraged returns, I am talking about someone else's money. Not my money. More leverage, higher returns. The reason leverage is so important is because the higher the leverage, the higher the return. For example, if I buy a $100,000 rental unit with my money, and I receive $10,000 a year net income, my cash-on-cash return is 10%. If I borrow $50,000 and am still able to receive a $10,000 return, my cash-on-cash return is 20%. If I finance the entire $100,000, and still receive a $10,000 return, my return is infinite. Infinite returns mean money for nothing. $10,000 flows into my pocket, and nothing comes out. The renters cover my expense, and I receive the income. Money for nothing. In my next example, again using the 300-unit apartment house, I will explain how I receive an infinite return by using leverage. The way this will be done is by raising rents and adding washers and dryers to each of the 300 units. This is how the numbers work in oversimplified terms. The net $100 a month increase in rents is due to increased rents to match the competition, upgrades to the exterior, and fitting each unit with washers and dryers. This $100 a month increase in income is a 100% finance transaction. We get extra money from the bank to do the renovations. We have the control. The increase in debt is more than covered by our increase in income. This extra $100 is technically an infinite return because all the expense is fronted by the bank, and all the returns come to me. The increase of $100 per month is multiplied by 300 units. This is an increase in gross income of $30,000 a month, and $360,000 a year on top of the cash flow we are already getting. This $360,000 is an infinite return, measured by cash flow in hand, not some fictitious capital gain on paper. In summary, The bank puts up 100% of the money for these improvements and we receive the increase in income. The tenants pay for expenses and the mortgage. 3. IRR, internal rate of return. One of the more complex, sophisticated, and often confusing measures of ROI is the internal rate of return. If investors really know what they are doing, they can increase their ROI by understanding IRR. The following diagram explains as simply as possible this more advanced way of measuring true investor returns. In overly simplified terms, internal rate of return (IRR) measures the other returns and other leverage that a well-controlled investment can provide. 1. Income column. Passive income. Most people understand that gross rents are part of the income column. Yet IRR also measures other forms of income. Passive income is subject to lower tax rates than earned income. In the U.S., passive income is not subject to Social Security or self-employment taxes. In other words, these taxes do not show up as expenses in the expense column, which is technically a gain in income. 2. Expense column. Depreciation. In the U.S., the tax department gives some investors an additional income that actually looks like an expense. This income is known as depreciation. Another term for depreciation is phantom income. The reason it is phantom income is because it's income that shows up somewhere else. For example, let's say my tax bill is $1,000. The IRS may allow me to depreciate my investment by $200, allowing me to pay only $800 in taxes. This additional $200 is phantom income, or money I did not have to pay. It is $200 that remains in my pocket instead of going to the government. Depreciation is allowed for such things as refrigerators, ceiling fans, carpet, furniture, and other items that decline in value with age. A tax accountant can explain this to you if you own a business or real estate. There is no such thing as depreciation for paper asset investors. 3. Liability column. Amortization. Another form of income to the investor is known as amortization, which is a fancy word for paying off debt on a scheduled basis. When you have good debt that someone else such as a renter pays for you, amortization becomes income to you. In other words, as a tenant pays down my debt, that payment is technically income to me, income that is paid to reduce my debt as my cash stays in my pocket, ready for the next great investment opportunity to come my way. Additionally, while my tenant is paying down my debt, I still receive all the tax benefits associated with my investment. 4. Asset column. Appreciation. Appreciation is the increase in asset value. This is also income to you. This is not appreciation based upon some appraiser's idea of an increase in sales price based on comparative sales in the area. The way I measure appreciation is by the actual increase in income to my income column. For example, the increase of $360,000 in income from my 300-unit apartment house is measurable. This is not an exact method for defining IRR, but it gives you an idea of how an investor can increase his or her return on investment far higher than most investors can receive from paper assets. At least you have an idea of what an IRR is. I would guess 95% of investors have never heard of internal rate of return. So you are now smarter and sharper than 95% of the investors out there. The exit strategy. The beauty of the exit strategy on the 300-unit apartment house is once again the use of leverage to become even richer. Instead of selling the property and facing substantial capital gains taxes on the profit, we pull out the money by refinancing. We are able to do this because we have increased the value of the property through our improvements and management. The bank recognizes this increase in value and we are able to borrow against it. By leveraging the property's value, we pull money out of the property tax-free, and the improved operations more than cover the higher mortgage payment through higher income. By borrowing rather than selling, we get our down payment back, tax-free, and we get to keep the asset. At this point, the property's income is an infinite return because we have no money invested in the deal, yet we receive the income. This is the ultimate leverage. Let's say after 5 years we are able to refinance the property and pull out $4 million tax-free. The numbers are in the diagram on page 122. The $4 million refinanced dollars go to the investors, and pay back all initial equity and then some. Even better, we still maintain control over the 300 units, and the increased mortgage payment of $280,000 is paid for by the $360,000 increase in income. The $360,000 increase in rental income, minus $280,000 in increased interest expense, leaves a net $80,000 in passive income. This $80,000 is an infinite return because the investors have received back their initial investment, yet still receive cash flow. It is free money. The investors get $4 million back and move on to purchase another apartment house. This is an example of using control and leverage. This is an example of getting rich according to the rules of the new capitalism, capitalism based on the use of debt to become richer. Rather than work hard to get out of debt, as those who follow the rules of old capitalism do, we work hard to find ways to get into more good debt and use more leverage. Starting with nothing. To some of you, a $17 million, 300-unit apartment building sounds like a big investment. To some of you, it's a small investment. 10 years ago, buying a 300-unit apartment seemed big to Kim and me. 10 years from now, I am certain it will seem like a small investment. Kim, Ken, and I are already planning much bigger projects to take on. Donald Trump and I are looking at a massive project not far from my home, a project we will break ground on in 10 years. I mention the size and dollar amounts of projects to make 3 points. 1. Being born poor and financially uneducated does not mean you cannot become rich. Very few people are born rich enough to buy a $17 million apartment complex. And no one is born smart enough to acquire, finance, and manage a 300-unit apartment complex by themselves. In other words, not having any money or financial education isn't an excuse not to get started. Yet billions of people let the problem of not having money or enough education stop them from becoming rich. They fail to take the first step. And if they do take the first step and then fail, make a mistake, lose money, or run into problems, many quit. That is why for billions of people, a $17 million project will always seem like a big project, a project bigger than their dreams. 2. Start small and take baby steps. In 1989, Kim's first investment was a $45,000 2-bedroom, 1-bath home in Portland, Oregon. She put $5,000 down and made $25 a month. She was extremely nervous when she took her first step. Today, a $17 million apartment house is boring to her. She is ready for bigger projects. In 1997, Ken McElroy started with a 2-bedroom, 2-bath condo in Scottsdale, Arizona. It cost $115,000, and he put down $23,000. He made $50 per month in cash flow. Today, he controls a real estate portfolio worth hundreds of millions of dollars. I bought my first investment property in 1973. I had no extra money to invest. I was still in the Marine Corps and had just purchased my first home. Rather than let low pay and no money stop me, I signed up for a real estate investment course for $385. Within a few months I purchased my first investment property, a 1-bedroom condo on the island of Maui, for $18,000. The property was in foreclosure, and the bank was desperate to get rid of the unit. The bank let me put the $2,000 down payment on my credit card. The property made me about $35 a month after paying my mortgage and credit card bill, which is an infinite return, since I borrowed 100% of the money. Once I proved to the bank that I could manage the property, it let me buy 2 more units. My investing career was launched. About a year later, I sold the 3 properties for approximately $48,000 each and put nearly $90,000 in my pocket. Not a bad return on a $385 seminar and credit card down payments. Even though I did it, I do not recommend that people use credit cards to make down payments. I do, however, recommend that a person read books and attend seminars before investing. One of the reasons the Rich Dad Company has intensive investment seminars is because I strongly believe in the power of our minds. Our minds are our most important form of leverage. At our seminars, the instructors are fabulous. I must admit that they are better teachers than I am. They are much more focused and thorough with their content and delivery. They are well trained, dedicated to your success, and, most importantly, they practice what they preach. Most students report that our courses open up their minds to a world of new opportunities, different ways of becoming financially free, and change their lives forever. You can find out more information on our website, richdad.com. 3. Dream big. Most of us know that a child must be allowed to dream. The same is true for adults. As a couple, Kim and I have big dreams. Our dreams keep our marriage rich, young, and fun. Bigger investment projects keep us learning together. operating as a team, and growing together rather than growing apart. Instead of living below our means, we dream big, learn, and invest carefully in order to go beyond our means. It's not just about money. It's about life. Personally, Kim and I think it is a tragedy to live below your dreams. In conclusion, on August 9 and 10, 2007, as the markets of the world crashed, many people had no idea what the crash meant. Most people have no idea how it will affect their lives. Most people have no idea how the rule changes back in 1971 and 1974 have affected their lives. Today, even in the richest country in the world, the US, millions of educated, hardworking people are earning less even if they are paid more, saving money that is losing value, clinging to their homes as their value declines, and using credit cards to pay their bills. To make matters worse, because of a market crash, millions of educated, hardworking people think that investing is risky and to attain higher returns means you have to take on greater risks. There are only a few people who know that the key to leverage is control, and the key to control is financial intelligence. The good news is that the higher your financial intelligence, the more money you make without needing money. In this new capitalism, it is truly possible to make money for nothing. In the information age, knowledge is the ultimate leverage. The more money you make without money, the higher your ROI and IRR, and the higher your financial IQ. Since financial IQ is the numerical measure of financial intelligence, this means an infinite return means an infinite financial IQ. Tell that to your banker and financial planner the next time they tell you that 5% interest on savings, or 10% return on mutual funds, is a great return.